FORA.tv. The world is thinking.
Jeremy, getting back to the stock market, and feel free to talk about other investments if you want to, but where should we be putting our money right now? I know it's really important to be a long-term investor and have a diversified portfolio, but which sectors do you think will be doing best and worst over the next year, and is there anything you wouldn't touch with a 10-foot pole?
Sure. I think there is one thing that she just mentioned, that it is 95% of your portfolio's behavior and your ability to reach your goals is driven by your asset allocation and diversification over time. But that's historical and it's boring. So let's talk about stuff that's a little bit more fun, something that you might be able to bring to a cocktail party or call Jim Cramer with. If we look at it, 5% of your portfolio's behavior is going to be predicting the future. So we're going to, again, get out our crystal balls and take a look at where we should be going. And I think I can frame that up two ways: what you shouldn't be doing and then what you should be doing. Two things that I think long-term investors should not be doing is, number one, keeping their money in cash. And number two, chasing the hottest sectors of the market, which are commodities and energy. So number one, keeping your money in cash. Say you're earning 2% right now. 2% minus taxes, adjusted for inflation, gives you a guaranteed negative return. It's not going to get you to your goals. Guaranteed, we already know it. Chasing the hottest sectors of the market, oil, energy, commodities, they've really run up, and I really believe in reversion to the mean. Things go up, and they come back down to that mean line. We had tulip mania. People paid $1 million for a single tulip bulb. They're crazy. You had more recent times, the tech bubble and the housing crisis. And both times it was, no, it's different this time. So I think that the same thing with oil. People say it's different, and we can debate whether it is or not, but I truly believe there will be a reversion to the mean. So those are the two things that I think you should not do. What you should do, I think a lot of people right now, taking a look at first the size of the companies they invest in. Most people have domestic large companies. A lot of people have foreign companies because it's been the best performing area in the market the last few years. Their portfolios might have too much international in it. It might be a good time to take some of that foreign off of the table and move it back into small companies. We're consistently seeing investors without enough exposure to small companies, which have underperformed, but things are cyclical. They will get their day in the sun again, and it could come sooner rather than later. As far as sectors, at Charles Schwab, we like healthcare and technology. It's kind of a two-pronged approach. Technology historically has been very volatile, but as we start to come out of recessions, it's performed well. Companies need to spend money on their technology to increase their profits when business is bad. They start investing in technology, and it starts to pay off as the economy recovers. Healthcare, on the other hand, has been very stable historically during times like we're seeing now, during downturns. It's a good place to go to try and earn a consistent return. We think there's some great valuations and opportunities there. As far as what I wouldn't touch with a 10-foot pole, again, it's got to come back to that oil and commodities. I think that it's probably a good time to take some of the money off the table there. I'm not saying get rid of your whole exposure to energy. Maybe bring it back down in line with the rest of the market. But it's probably run up a good bit lately. Might be a good time to take some of that money off of the table.